Welcome for another episode of Stable School. I'm Zach, joined by Joao from M0. Hello, Joao. Thanks for joining us.
Thanks for having me.
Could we start by introducing yourself and describing your role at M0?
Sure. I'm Joao Reginatto. I'm Chief Strategy Officer at M0, which it's always a little bit of a fluffy title, right? What is a Chief Strategy Officer? But the reality is that I have been in the stablecoin space for a very long time, probably more than the average for sure, in terms of builders. I joined M0 about 2 years ago. And prior to M0, I was at Circle for 8 years. I led the build out of USDA, which is the second largest stablecoin in the world today. I led the stablecoin product teams at Circle for many years, since the inception and build out of USDC all the way to 2023 when I left. And so at M0, I have my finger on a couple of different pies, but I run this strategy function. M0 is a stablecoin issuance platform, so it helps app developers essentially use stablecoins as a proprietary digital dollar stack for their applications, and we pair them up with stablecoin issuers on the other side of the platform. And we can talk more about what that means, but that's
Super
me.
Cool. We definitely have never had anyone on the podcast who's been building stablecoins for 10 years. That's like very extremely rare. How's it been for you watching the space just explode vertically this year?
Yeah, it honestly feels a bit surreal, and it feels like every day that goes by that there's more and more news about the space, right? I keep telling people just wait one more day and there will be more stablecoin announcements. It feels like it is stablecoin summer, if some people are coining the term that we are living, that we're living through. And I think we coined, or somebody, I actually don't know where the term stablecoin emerged from. Somebody coined it right when we started studying it at Circle, and prior to the build out of USDC, these instruments were already known as stablecoins. But I think the technology stack and actually even these instruments in and of themselves have changed dramatically over the last 10 years. And probably what we are going to discuss going forward in terms of stablecoins is very different from what people like you and me who have been in the space for a little longer understand as stablecoins. I think the shift that we are seeing is a shift that I think it's common in technology. When you start with a product that is successful, but it's very kind of horizontal from a technology point of view, meaning it's general purpose in nature, because the use cases are not very solidified. You build something and then you try to, pardon my word, but you try to shove that solution like in many different use cases. And with time, usually what happens with technology is people figure out, oh, there is now this niche and this other niche and this other application for it. And that tends to drive customization of technology then. Then you start moving away from these horizontal solutions to more vertical solutions. I think we're going exactly through that phase in the stablecoin sector, if you want to call it, meaning we are slowly moving away from the first iteration of these products, which are the Tethers, the Circles of the world, into, for number one, a much more fragmented market where way more players are going to try and participate. And this is what I said. Every day I make a bet that tomorrow there will be another stablecoin being announced, and so on and so forth. So there will be a fragmentation, a proliferation, but also more customization, right? So these products are going to be looking a little bit more like technology and less like an asset. And I think that's also the shift that we will see, that for the last number of years, we thought of a stablecoin as a digital dollar on chain that, you and I could hold in our wallet. And it's literally a digital dollar. So there was a number of use cases potentially for it. Now I think people are going to realize that it's actually really powerful as a developer piece of infrastructure. So in the same way that you build financial services on top of banks today and payments processors and all that kind of stack, you can build financial services now on top of stablecoins as a piece of developer technology. And so the shift that I think we will see is that all the complexity and all the knowledge of that technology will be pushed behind the scenes, and users, which is the way that typically successful technology works, they don't actually realize they are touching it, right?
Exactly.
They don't know the best products, as Steve Jobs said, work like magic. So you will use a financial service or an app or a game or whatever it is. Maybe you will have a dollar balance that might be powered by stablecoin infrastructure behind the scenes, and you will not know. Whilst today, people tend to think about stablecoins as this thing that I know, it's USDT on this chain or USDC on that chain, and I think we will push it behind the scenes. But I think we are right at the cusp of that transition. That's why it's very interesting and very fluid, and a lot of experimentation will happen.
Yeah, it's so crazy. We've been talking about this day coming for years,
Yeah.
but the surreal feeling shows we weren't actually sure if it was coming or not. And as a space, here we are. But it's going to be like how, none of us know. We all use email, but we don't know what IMAP is.
Exactly.
And that's,
Or SMTP or
exactly, yeah.
or POP. There was a time where people actually knew those things.
Yeah. And my generation, we definitely didn't need to know. We just signed up with Gmail and it was all magically set up. It's so cool. We're heading this direction. But I think this is the perfect segue to mention, like, for all the newcomers watching, what is M0 and what is issuance platform?
Yes. So I'll tell a little bit about the background that I, in my time at Circle, building USDC, bringing USDC to market. Obviously, I have had literally thousands and thousands of conversations with people, in particular builders, right, who had a use case and they wanted to integrate USDC, and that's my background. The two co-founders of M0, Luca Prosperi and Greg DePrisco, they both come from the Maker ecosystem, so they have the same amount of expertise and experience, with a slightly different type of construct. Maker and Dai were very, very foundational and very innovative in how they created this sort of more decentralized solution for stablecoins. But I think we both, all three of us, and more of the team at M0, who's all in general very super experienced in stablecoins, we have all witnessed this trend over the last 5 years at least, right? Which is developers, in particular builders, they thought of stablecoins as a way to substitute the technology stack that people use to build financial applications, as I said. Even the way that over time we saw centralized exchanges that did not have a banking partner, did not have a bank account anywhere, did not have fiat rails, as we call them, and yet would have dollar-denominated markets and the ability for you to send digital dollars in and out of the exchange. That's literally an equivalent way of building one of these financial applications without relying on the traditional tech stack for money. So I think we witnessed this trend that, as I said, stablecoins would not be just a bearer asset, which is a really cool thing, by the way, a digital dollar instrument that works like digital cash, but it would be a piece of technology that people can build on top of. So that was the genesis for the founding and the creation of M0. M0 is essentially a stablecoin platform for developers. It works as a substrate where developers can build applications that depend on digital dollar infrastructure. So the way that it works is that, think of it as essentially a two-sided platform. So on one side of the platform, we have application developers that have this need, right? So they want to own the destiny. They want to be sovereign with their digital dollar infrastructure. They don't want to depend on very large incumbents. So they come to M0 and they customize how a stablecoin should work for their use case, right? What behaviors it should have that are specific. Maybe it's closed loop, maybe it's open loop, maybe the transfers have some sort of permissioning, maybe they have a check for identity. All these things, it can be really programmable in the way that people talk about programmability, but it's actually usually not possible with existing stablecoins. And most importantly, what's very important about the platform on that developer side is the monetization aspect, right? Because stablecoins, in the way that we know them today, they're typically backed by a certain profile of asset that is yield generating, and there's always the question of where this yield should go or goes to. And if you are a fintech builder and you are the warrior in the arena, kind of acquiring customers and sweating blood and going through all the pain of building a business, you should be able to monetize your customer deposit base. You shouldn't have to hand it over to somebody else. So that's one side of the platform. It's serving developers. M0 has SDKs and infrastructure to create all that customized technology for developers. On the other side of the platform, then we have stablecoin issuers. And our belief is that there should be a multi-issuer model for these instruments, and they should be interoperable in the same way that on the commercial banking system that we know today. Let's say if you have dollars on Bank of America, and let's assume we live in the US, you have dollars on Bank of America and I have dollars on JP Morgan. These are actually different form factors of dollars, right? And they actually, you could argue that they actually have different risk. They are on the balance sheet of banks that, are isolated entities and work in a different way. And yet our value is interoperable, right? So when you send me money, I get the same amount of money. And people don't question why that is. There is no marketplace for you to trade Bank of America dollars for JP Morgan dollars in the same way that we have it in crypto. So there is infrastructure that was created over the years, right? So there are central banks, clearing houses, all these things were created over time as a way to deliver essential interoperability and to create like an economy that actually can scale. M0 plays that middle layer exactly between those two sides of the platform. So there's the app layer on one side, there's the issuance layer on the other side. We have standardized both sides, and we allow for a much more interoperable and liquid world to exist, within all these venues then. So, for example, we have recently issued the MetaMask dollar for MetaMask, right? I'm sure we'll talk a little bit more about that. But if you have a developer building that type of custom stablecoin on M0, it will be interoperable by default with any other stablecoin built on M0, meaning that when you move funds from one of these M0 use cases to another use case, you're not trading one stablecoin for the other, because trading is actually very poor from an interoperability point of view. First of all, you need to have both assets available and liquid at the same amount for you to be able to go from one side to the other, which makes it kind of capital inefficient and costly, right? Because if there is a market, there's always an opportunity for price to be discovered and deviated from what the price should be, which is always one. So instead with M0, you actually, it's more like these assets are destroyed at the source and recreated at the destination, so that you actually have all the value always flowing from one use case to the other, without price discovery through a better interoperability solution. And as I said, on the issuer side, then we have two issuers already on the platform today, a company called MXON and Bridge, a Stripe company. They both use the same set of smart contracts. They all issue this canonical stablecoin called M that then gets wrapped or gets like equipped with the customization that developers create and essentially instantiated on all these use cases in a particular way. So it's a very complex platform. It's a very sophisticated model, but we think it delivers first of all, the ability for developers to build custom technology, which is what they want. There's a huge demand for that right now, while maintaining interoperability and liquidity sort of as a network. So that's essentially how we describe it.
It's so cool. Yeah, we first met in Brussels last year. Yeah. When you guys were launching, and was that true? Were you guys launching?
Yeah, we launched about a year ago now. Yeah.
Yeah, and this is definitely the clearest I've understood M0. Like it's a complicated platform, like you say, but it's been really exciting to see the growth. How has that growth been over the last year?
Yes, it's. As it's the case with startups, right, or nascent projects, and particularly with something that looks like a two-sided platform as M0 is, it's very hard to go to get up from zero, right? So you start from zero, and then how do you grow? Well, let's develop use cases, right? But if you go and try to develop use cases and you don't have at least one issuer on the back end, the use cases can't be built. But then if you decide to start on the issuance side and you try to attract issuers, and there's no demand, they're not going to be interested. So it's the classic cold start problem of a platform. So we went through that in the beginning. We spent about 18 months building the platform on stealth. As you said, it is complex. It is sophisticated because we deconstructed everything and started building it back up from first principles. And then naturally you create something that's sophisticated for all the possible applications that we intended. We spent some time talking to folks in the market, trying to attract these two sides of the platform. Eventually, we decided to bootstrap our own issuer. And say, well, how about we build our first stablecoin issuer, and we demonstrated to people this is how it should work. This is a blueprint for it, and then by having the first issuer, we can go and acquire some use cases. So we did that. That was the way that we kind of crossed over the cold start problem. Then we have an extensive network, that has built with us in prior lives that Luca and Greg and myself and others have had in stablecoin. And so we started to attract those companies. They built a couple of use cases on M0. The first successful one was the Noble chain, which is a stablecoin issuance chain for the Cosmos ecosystem. They had this idea, which again now it sounds extremely popular, right? Everybody's now talking all of a sudden about ecosystem stablecoins, chain stablecoins, and Noble was the first one to do it. Noble created a Noble dollar last year. It was the very first builder on M0. And that again then demonstrated the utility of the platform on the application layer. So once we had the two sides, then the flywheel started to happen a little bit more. And more recently then we have through working with the consensus with the MetaMask team for a while, they were really interested in our model, but they wanted issuance that would happen out of the United States, given what happened with the Genius, like increased clarity. And so we went to the Bridge team and we said, look, we have this really cool use case here. They were aware of the use case, but we would love for you guys to be the issuers for this. And would you integrate with M0? They said yes. They deployed resources and they did a great job executing, and they became the second issuer on the network. And so now we are in this phase. And I would say the third thing that I would mention then that happened recently was then actual growth, right? Because then you start having the third and the fourth and the fifth stablecoin built on the platform, and they start growing. They're completely different use cases. They start growing in different directions, and sometimes you start seeing explosions of growth, right? So recently, we have had the MetaStreet team called this product called USDA, which is not precisely a stablecoin, but it is a digital dollar instrument built on top of M0. It provides essentially like loans for the creation of AI infrastructure, data centers, that kind of stuff, and they have experienced like explosive growth over the last few months, which has pulled up then M0. And today the state of the platform is it has about $750 million of circulating supply across all the stable coins that are alive. That puts us in about top, I don't know, I haven't looked at DeFi Llama today, so it could be different, but let's call it top 13, top 14th kind of stablecoin project from a TVL point of view, which is pretty good after about 12 months. We are about the size of Paxos USDG, the global dollar. We're about the size of the Ripple dollar. So, we're beginning to be relevant and more recognized, and people want to, what is M0? What do you guys do? And so we're having that kind of more discovery-based conversation, which is really cool. And we are going to launch more stablecoins for more teams in the coming months, and we're really excited about the beginning of that inflection point.
Super cool. And just because you mentioned Paxos and Ripple, how many people are there on the M0 team?
So across all the different entities, the issuer, this company called MXON, which is a mini stablecoin issuer, very, very lean and mean, as we say. They are a separate entity now. They operate separately. But if you count everybody who is involved in one way or the other in the M0 project, it's around about 40 people.
amazing. Double digits, up there with these massive companies. Like.
We are way smaller than any one of these other guys that are punching at the same weight, and I think it's the classic thing that, again, the classic waves of technology progression, right? You do more with less. Like the reason why we can do so much is because we have re-architected this stack. There's so much complexity on our smart contract infrastructure, so the machines are doing a hell of a lot of the work.
Awesome.
And you don't need as many humans then.
Super cool. Yeah. No wonder USDA was a natural fit.
Yeah, exactly.
Yeah. So you talk about rebuilding from first principles. I think on Stable School we've covered, fiat-backed stablecoins. We've covered CDPs. We've covered like algorithmic stablecoins like Beanstalk, and what backs M0? Where does the dollar come from?
Yeah, great question. Thanks for asking that, because I did not touch on that side at all. So think of M0 as a network, in the same way that Visa is a network, right? So networks, they exist because they have some ambition to standardize a particular type of technology to allow for several diverse partners to come in and plug in and perform the same role, and you create some sort of competitive dynamic. It tends to push costs down, create competition. It's really good in general, network model. So in the same way that Visa does that for card issuance, M0 does that for stablecoin issuance now. So in the many network rules that we have at M0, there's one definition which is called eligible collateral. So stablecoins, they need collateral, they need reserves, depending on what type they are. But usually, if it's not a fully algorithmic thing, you need some sort of collateral. We went for the non-questionable option, right? Really what has become, I think, the golden standard for stablecoins, which is, eligible collateral is short-term U.S. Treasuries, at least for dollar-denominated stablecoins. So we like to invent a lot on the behavior side of stablecoins. We don't like to invent so much on the value side of stablecoins. That we have been through the last 10 years. We have, I think, landed on a good spot. So we just operate in a very vanilla way. So the definition, just to go into a little bit more detail, the definition of eligible collateral for M0 is the issuers have to be holding short-term U.S. Treasuries. But there is some flexibility in the form factor of how they hold those. So they can be actual treasuries held in a custodian, a bank or asset manager. But they can also be tokenized U.S. treasuries. And we recently made that change and that kind of expansion of the definition of eligible collateral. Because tokenized U.S. treasuries are actually really useful for U.S. issuance, particularly for stablecoin issuance, particularly if you want to make it more automated. And as I said, we're very biased towards automation, because tokenized U.S. treasuries, they live on chain. So, they're always on 24/7, right? And you have, you can determine the profile of liquidity, so you can actually predict, the amount that you can mint and redeem. So we work with, we onboarded Superstate USDB product. It's the only tokenized U.S. Treasury form that we allow as collateral today. It doesn't mean we don't think the other products are good. It just means that we think the Superstate team did a really good job in how they designed that product. It's really useful for stablecoin issuers. And so our issuers today, both MXON and Bridge, they hold reserves for the M0 stablecoins, essentially in a mix of normal old style U.S. Treasuries in the custodian and tokenized Treasury on chain. And I think one important thing then for people to understand is the way that we also standardize the existence of this collateral is we delegate the responsibility for proving that this exists to independent third parties. So the issuers, they hold that collateral. And if they are in possession of that eligible collateral, they can come to the M0 platform and mint stablecoin. But they need to go through a hurdle first, which is they need to prove that collateral is there. And the way that they do that is we have a set of what we call validator companies. They're independent companies that the work that they do is they are able to look through to the reserves, whether they are reserve accounts or reserve wallets of these issuers. They have read access, let's say, and they can say, they can see and say whether the collateral that the issuers claim to be there is actually there. So in the M0 protocol, the way that it works is the issuers on a daily basis, they effectively need to make a proof of reserve that is signed by these validators on chain. So they make a statement, they say, I have $100 million in collateral, and a validator externally looks through and says, yeah, you actually do. And so I'll sign that cryptographically on chain and publish that on chain. Yeah. And with these signed messages, the issuers can then mint stablecoins. So it's a very secure mechanism, and that's also another side of the platform that we are going to grow over time. It's these companies that are actually just performing validation services.
Yeah, that's so cool. I don't think I've ever heard of a 24-hourly attestation. Is anyone else doing that?
It's very hard to do that. That was the in my time at Circle, we have gotten to monthly attestations. There are stablecoin issuers in the more traditional way that do a little bit better, a little bit worse than monthly, but monthly has kind of been accepted as the minimum standard. We do it daily. I think it's a significant improvement. And I think, again, technology evolves, so why shouldn't you be pushing? We actually do daily, but it's a parameter setting on the protocol. It's actually not daily. It's a little bit over 24 hours because we give time for people the issuers to sleep if they need to, but they need to, there's a clock ticking and they need to prove this collateral every day. But that parameter can keep going down and I think as the technology solidifies and these validators become more used and more automated, we can push the collateral proof to 12 hours, 1 hour,
amazing,
10 minutes. We can keep pushing it down.
And that's really always been the kind of not just the goal of stablecoins, but the goal of crypto as a whole. Because you just think about things like 2008, how much more control users would have had if banks had to attest every 24 hours.
Absolutely.
Every 12 hours. So cool. And I think this is it brings me to an important question, which is, if I were a protocol or an exchange, why would I issue my own M token instead of my own stablecoin? What is the big difference?
Again, those are great questions. Thanks for asking. There has been instances already of whether it's centralized exchanges or other types of applications, right? Of people attempting to build their own stablecoin, and we had, I think the first major example of that was Binance doing BUSD issued by Paxos, and then many other entities have tried that. PayPal was like a very well-known one, and so on and so forth. However, there's a problem with issuing your own stablecoin depending on how it's done. So the proof is always in the pudding and the details. And users don't care about this, but from a builder point of view, it's actually really important. If you just build a stablecoin completely in isolation from anything else, you become this completely isolated asset from everything else. And money is it's kind of a network effect product. So if you start with a brand new form of money, you start with a network of one node, which is you, it's going to make it really hard for you to actually get utility behind that form of money, because I need you to also use it, and I need somebody else to also use it, and you need to keep expanding that network to multiple nodes, and the more nodes you have, the more useful it's going to be. If you're building on your own, if you're going alone, that's going to literally be like pushing a massive boulder up a hill. It's a really, really costly endeavor, and it's very expensive from a liquidity point of view, because every time that people then want to try that and they want to convert like some other form factor of money into yours, you need to have your form factor of money kind of ready there to be traded, right? And so how do you procure that? And because the more you grow, the more you need to procure that, and the more expensive it becomes. So the pitch that we have as M0 is for these use cases, and to go back to your question, is don't go it alone. It's never nice to go alone on a journey. Like go as part of a team. Like join a network, right? So I think there's going to be use cases where people are confident enough that they have distribution power to create these network effects, and probably a few will be successful. I think the majority will not be successful though. And if they instead do that as part of a network like M0, then they can already tap on the liquidity of all these other use cases, right? So, for example, if I create my Joao dollar on top of M0 now, I could go to the MetaMask customer base and offer something to those users, right? And say, hey, if you have MetaMask dollars, come and deposit them on my use case, my Joao use case, whatever it does. And it's going to be super cool. And there will be no liquidity friction in that, because if they bring a MetaMask dollar to another M0 use case, again, there's no price discovery, there's no liquidity that's needed, because the MetaMask dollars that get destructed, that function, it's the function that creates my Joao dollars then. That is a little bit of a magical difference that makes it entirely easier for you to launch a use case on M0 than it would be for you to launch your own stablecoin, your own use case independently. It's literally a network effects kind of justification. It's the same idea that, if you want to participate in a telephone network, like join an existing telephone network. Don't create your telephone network and with your single telephone number, because that's going to be a bit lonely. So it's a little bit of that.
Yeah, it's teleportation instead of ships, right?
Yeah, I love it. I love it. Teleportation is a really good analogy.
Instead of the AMMs, which are just so insanely capital inefficient.
Exactly.
Oh, it's so cool. And then I think with that in mind, the MetaMask USD integration is going to be huge, because that's going to put M in everybody's hands. Like, I haven't used it for months, maybe years, but I have MetaMask on my phone still.
Yeah.
And if that interoperability play is going to start being crazy, how do you guys view that MetaMask USD, and how much of your strategy moving forward is that going to be?
Yeah, no, I agree with you. I mean, MetaMask is the OG brand in digital wallets and crypto wallets, right? So there's been a lot of innovation over the last few years. There's a lot of great wallet products out there, particularly in how the proliferation of layer ones also created, the most well-known kind of digital wallet in each ecosystem. But MetaMask is still very likely the most well-known, crypto wallet out there. And so it commands a lot of respect, right? Everything that they do, people stop and they listen and they go and they find out about it. And but also MetaMask is a suite of products today, right? It has evolved over time to be like a swap aggregator and a card product, and there's Linea, the consensus layer one, like behind the scenes. So there's a lot of building blocks in terms of how they construct the entire end user experience. So the MetaMask dollar, I think, has been launched about 3 weeks ago. It has about $65 million in circulating supply. So, pretty relevant for a 3-week-old product. But I think it's only the beginning of how they're thinking about incentivizing the usage of it more, right? So, and again, we as a platform, we don't prescribe how these digital dollars should be built. We just give the builders the tools and they decide how to do it. So MetaMask in particular, it's not a yield-bearing stablecoin, right? It's more like a payment stablecoin. Like you hold it, if you hold $100 worth of it, tomorrow you're going to have $100. You're not going to have a different amount. But MetaMask is monetizing that customer base, the deposit base, I should say. So now all of a sudden, the underlying yield that's being produced by the reserves that are backing the MetaMask dollar are flowing directly to MetaMask as revenue, as a way to monetize those deposits. So the team now has an additional source of revenue, right? That they can further create positive cycles, right? So they can say, well, what if we say that by holding the MetaMask dollar, when you're spending with your MetaMask card, you're going to get some extra loyalty incentives.
Some points,
How about we go and we do that? How about when you use the MetaMask dollar on a DEX in the MetaMask ecosystem, you get a little bit more incentives for doing that. And so I think naturally you need revenue, to invest in those things and to promote features and parts of your product. And now MetaMask has that additional line of revenue that they didn't have from other stablecoins in the ecosystem. And so I think we're very bullish that this product should begin to grow and become more popular in the coming months.
Amazing. This is not on my prepared list of questions, but I'm just curious. Like, issuing with M0 sounds like a much sleeker experience for companies than developing themselves, both in terms of the tech and in terms of the capital they need. How long does it take from me, Zach, I want to issue Zach dollar, I come to you and I'm like, Joao, set me up. Firstly, is it that permissionless, and how long what's the kind of time frame there?
Yeah, that's another important point. So there's a lot of competition now. There's a lot of different models for that type of offering. We think building your own digital dollar, if you wanted to build the Zach dollar, it's actually a really important decision for you, right? Mm-hmm. So there's usually a little bit of time involved in the design of that product, right? So I think there are some attempts right now at creating in-the-box solutions or point-and-click solutions, right, where people can come in, click, and create their own stablecoin. I don't know, in my experience talking to customers, I don't know if we are ready for that yet, because it's a little bit like buying a house, right? You don't go online and buy a house. You go online and you look at 100 options, and then you visit 20, and then and then your wife and your mom and everybody will have an opinion, and then eventually you make a decision. It's a big decision. It's not easily undone. I learned this from Jeff Bezos at Amazon, right? You should always think about a decision. Is it easily undone or not? If it's very easily undone, just do it fast, right? Don't think too much about it. Follow your gut, follow your experience. If it is very hard to undo that decision, you bet you should spend a lot of time thinking about it. So a lot of what we see with our clients is spending a significant amount of time there, strategizing, right? What does it mean to have our own dollar for us? How are we going to use all of these different features? And there's a good amount of weeks that typically people spend there. In terms of the actual build out, then we have SDKs, we have templates that are ready to go. And the more we see patterns in what people are building, the more we kind of templatize those patterns again and put it back in our infrastructure. So there's a couple of models of stablecoins that if you're interested in that, you can get spun up in just a few minutes. And then there's the actual integration, and then there's what we call the enablement, because then you build these stablecoins, and then you need to basically be permissioned on the M0 network to be now a recipient of the yield that is proportionate to your TVL. And that is an important decision for us, for the network. So in the same way that if you go to Visa and say, hey, I'm a new bank, I would like to issue cards on your little network, they're not going to permission you in a second, right? There's no screen for you to click and be permissioned. It's an onboarding process. They're going to look at your risks, because you're going to get a lot of upside, but you also bring risks to the network every time a new node gets joined. Similarly, every time a new stablecoin gets issued on M0, it can bring different risks. We need to know who are these teams, who are these builders, right? So that enablement is also another process, and it's dictated by governance. Effectively, governance decides whether a new builder will do that or not. So it is a permissionless process for a good chunk of it, all the way until that milestone. And that milestone, you need to be permissioned into the network. Otherwise, you can build a stablecoin using the M0 tech, but you're not going to get the upside from it. So it's, but just to give people an example, the MetaMask dollar was built in around about 4 weeks. And I think it was the probably the fastest one that we have seen. The consensus team did a really, really good job. I mean, when they came to us, they knew exactly what they wanted. Probably they had spent, their own cycles that we don't know how long it was strategizing this. But if you have a good idea, and even if you are that big of a use case, 2 to 4 weeks, it's around about the time that we have experienced as normal.
Wow, that's amazing. I'm really happy I asked that question. It was a good one. Not the question, the answer.
No, yeah, a good answer needs a good question.
Okay, so we're finally talking about yield, which is such a big topic in stablecoins. But I wanted to ask, as rates fall, where do you see yield coming from for stablecoins issued by M0?
Yes. I was actually on a panel earlier today at Token, and we were discussing the topic of yield. Before I answer your question specifically, one of the things I wanted to say is that I think, there are many trends in stablecoins today, and we discuss a lot of topics. But I think I would like to bring our perspective to the table on a couple of things. People talk a lot about yield-bearing stablecoins these days, right? And I've seen some opinions that maybe all stablecoins should be yield-bearing. I come from a product background, and I learned, by training, but also by making mistakes, that you can build products by asking people what they think they want and following that. And that's not a really good way to build successful products. Or you can actually observe what they do. And then follow what they actually do, right? I think in crypto, we are a little bit obsessed by yield because we are sophisticated people. If you are in crypto, you tend to be above the average in terms of how you understand finance and opportunities and things like that. So if you have an opportunity to gain yield on something, you will seek that, right? But the vast majority of end users of financial services out there, if you think about it, they're actually not like that. Unfortunately, they are less rational than you would expect. Or maybe rationality is not the right term, but what happens is actually they're happy to trade yield for convenience, exactly. Right? So if you use a checking account product, you're foregoing yield, and the bank is making, their business model on those deposits and not paying you yield. But you're probably trading that off for having a very liquid, payments account, right? And a debit card associated with it, and the ability to send money to your friends or to go down and buy milk and not have to wait 2 days for that to settle. All the benefits of that come from that utility. I think when we talk about stablecoins as the next generation infrastructure for building financial services, and we talk about the yield, I think the context of that is more of allowing the builder of the financial services or the fintech to monetize what they have built, not about the end user gaining some yield. And I think we like to sit side by side with our clients and build these solutions together with them. So we advocate a lot for this. It's hey, this is your product, and it's okay to make money off of your product. This is your baby, right? Everybody should make money out of their creations. And so think really careful about what you want to do with this, because this is your lifeline, this is your revenue line, and are people really asking for yield out there? I mean, there's hundreds of billions of dollars worth of tether deposits that would tell that people are actually not asking for yield. So I think it's an interesting discussion, and probably the truth is somewhere in the middle. Maybe crypto will help people get more access to more opportunities, but I still think monetizing the builder activity is actually really, really important. So on M0, again, we delegate that choice to the app developers, right? So they can get access to the yield and the reserves, but it's really up to them to decide what to do with it.
Yeah, I mean, that's so. I couldn't agree more, honestly. I was just having this passionate debate with a friend who was onboarding their friends to yield-bearing stables. And these are non-crypto natives. And I was saying, you're not doing a thorough job explaining the risks. And, I would, if I had to tell my mom to get some yield tomorrow, you know, I would be very scared of recommending some of the on-chain like 16%, 20%, because I won't know how to explain the yield to her effectively.
Right.
And you know what they say, like if you don't know where the yield comes from, you are the yield.
Yes.
And so it's so true. And like what the vast majority of people in this world want from their money is stability,
Yep.
not an extra 4%, because unless your size is size.
But I think I actually skipped like answering the core of your question, which is a good point. Yeah. So
down, yeah.
Interest rates are clearly on probably a path like down now, right? I think we saw the inflection point, and I think at least in the U.S. with the current administration, I think we should expect. I'm not an economist. This is not financial advice, but I think we should probably expect interest rates to go down, to go in a down cycle from here onwards. But the reason why I had that long preamble, and sorry about how long it was, is because again, this is not necessarily something that will impact end users, right? So I think again, a lot of people in crypto are a little bit anxious about decreasing interest rate environment, because end users are not going to want to use these products anymore, because maybe interest rates instead of 4, they will be 2.5 or 2. I don't think that's actually the case. I think we are on an upward adoption path from looking from another angle, and people will continue to adopt these products because they actually are more useful. They are more convenient, you know, increasingly. I think the yield that an end user gets is actually a small component of what we are seeing right now. And for a growing pie, for a developer, you know, making 4% or 3 or 2 is actually not that big of a difference. What they should focus on is on growing their pie, growing their deposit base, making their product successful, and they will find other ways also of monetizing their services. This is one component of monetization of revenue, but they will find others. But I think it's fair to say that probably these builders are also going to look for opportunities to kind of get out a little bit on the risk and the yield curve. And so I think naturally, with more adoption of stablecoins, I think we will see more demand for borrowing of stablecoins, right? And, you know, and maybe there will be an opportunity for people to make more money out of lending stablecoins. It's already, things like Morpho and Aave are super, super successful already with offering this to more and more users of more mainstream products like Coinbase and stuff. So I think you know, a decreasing interest rate environment is not necessarily a bad thing, because I think you know, there will be more capital flowing into crypto assets. It will turn the wheel of like crypto applications, and I think more innovation will be created and will occupy this space then.
Awesome. Yeah, no, for sure. So yeah, this is such a good perspective that not many people have, and yeah, it shows the OG status, Joao. Yeah, and I think we're close to the end now, and I think something we vaguely touched on this earlier, but something a lot of people don't really understand is how complicated interoperability can be among stablecoins, even when they're on the same chain. And then when you add in the fact that now we're dealing with dozens and dozens of chains, I'm imagining interoperability is it's very complicated for builders. Through all your conversations with people building on the M0 platform and people who want this kind of interoperability for their stablecoins, do you have any opinion on like a set of standards or like some goals that the industry should be working towards in terms of interoperability between different stablecoins?
Yeah, that's an interesting question. I think I'll start with the negative answer first, right? I think trading is not a good form of interoperability. I think we sometimes we in crypto, we think we have invented things, and we haven't really invented them, and sometimes we're actually rebuilding things that have been a really bad solution in the past in the traditional world. So I like to, because I've been in this space for so long, and I think we at M0, we share a lot of this. We call ourselves money nerds, right? So I have an entire library at home of like 20 plus books just on the history of money and the creation of all these components of what money is today. And if you go back, for example, to the early 1800s in the U.S. and what people called then the wildcat kind of bank phase of the evolution of the banking system there, you had all these disparate banks that started to emerge in the U.S. The first Bank of Texas and First Bank of California and all those things. They would all issue some version of a dollar, right? And obviously, it was paper-based. Back then, there was no other way. They were not interoperable at all. So, one banknote on one of these banks had nothing to do with a banknote on another bank. And so the way to interoperate, if you could, jump on a horse or on a train and go from one state to the other, like you had to pick a pile of money and discover, right, and go to some market and say, hey, I have this stash of like Texas dollars, right, like, how much do you pay me for these? And, and people would say, you know what? You are in dire straits, so I'm going to abuse you and I'm going to pay really, really low for those Texas dollars here in California. And so you have all these deviations, right? And then you don't like that trade, so you go and you talk to somebody else, and this is called price discovery in capital markets, right? And eventually you find a price that is acceptable for the seller and for the buyer, and that's the price, that is agreed for that trade. It's not a very good interoperability system, right? and then it turns out also that then the buyer side gets those Texas dollars and they're like, oh shoot, okay, I made a good deal, but now I need to offload this thing, and then there's the lack of interoperability makes people try to move away from these assets as quickly as they can. Then what happened then in that evolution of money is we created things like central banks. Not in the U.S. The U.S. opposed the idea of central banks. It created the Fed, which is a little bit more of a really beautiful federated model, right? Decentralized model. But other countries created central banks, and then other pieces of technology started to emerge, and you started to have rules, right? So standardization, okay, if you are a bank and you want to issue dollars, you have to do these number of things. So by doing that, you standardize, you reduce the risk of the variation, and you know that if people follow these rules, at least, then I know how to calculate the risk. And if I know how to calculate the risk and I understand, then I'm going to give them an account at this central bank structure. And then, because I know the capital that they have at this central point, if they want to interoperate between them, I'm going to guarantee the price as being the same, the value as being the same. They don't need to trade these things anymore. And I can use clearing houses or clearing processes to actually move the money from one of their accounts at this central entity to another account to the central entity. And that's how we eventually, arrived at the commercial banking system that we have today. So our point is that the interoperability solution that we have today with traditional money is way better than what we have in stablecoins. Because unfortunately for stablecoins, you have pick your number, right? 10 different relevant ones, 5 different relevant ones, 3 different relevant ones. It's more than one. And so there's always going to be the need to interoperate across them. And you have to trade them. And trading demands a lot of capital, right? So if somebody shows up with $100 million worth of USDC and they want the equivalent in Tether, you need that capital on the other side, right? You need to find that capital. The bigger the quantity, the harder it is to find that capital. So naturally, the more expensive. That capital could be doing something else. So people are like, oh, I don't want the capital to be here, so I'm going to charge a premium for it to be here. It creates all of these dislocation and incentives for that to be a smooth process. And some people say, yes, but if you look at the trading of these stable coins, the slippage is small, they almost trade 1-for-1. But at scale, we need this ecosystem to go to 1 trillion, 2 trillion, 5 trillion. So a little bit of slippage at scale is a huge tax in this crypto economy, right? We don't need that tax. So what we need is better technology. So if there were these standards, these rules, right, where you could say, yeah, this issuer obeys these rules, this issuer obeys these rules, there could be some sort of a central entity, not central in the bad sort of way that we reject in crypto, but a central in terms of an agreed upon set of standards that could say, Well, if you have something on this side, you can auto create stuff on the other side, and observe the destruction of this, and they're valued one for one, and you kind of optimize a lot of capital then, and then every new use case like joining this interoperable network benefits from that, and the movement of funds across these use cases is way smoother. So because M0 is still, we're trying to do this. I would say that that's like the pitch, right? So let's bring it down to reality now. The reality is we have 5 or 6 stablecoins live today. So there isn't a whole lot of interoperability that's required or even needed today across the stablecoins that are built on M0. But we are already beginning to see an interesting phenomenon. So, we're working with a huge pipeline of people that are building on M0 now. And they come to us and we say, oh, your use case is very interesting. Have you met this other team? Because they're doing something here that we think, you guys could partner and maybe allow your users to send funds to their use case. And then they're like, oh, that's really cool. I didn't know that company. And we're beginning to match them up. These weeks, for example, in Singapore with Token, it's a great opportunity for us to meet folks in our ecosystem face to face and make these introductions. And we're beginning to see the seed of these conversations like, oh yeah, your company is cool. Like we should have a partnership. And by the way, I will send you my dollars and you auto convert them into your dollars. And we get one for one. There's no trading, and you don't need to be holding, a stash of my dollars. I don't need to be holding a stash of yours. People are beginning to see the network effects and the potential synergies. It's not happening yet today, but again, it's a network business, and I think we, as humans, we tend to underestimate network businesses, but they tend to follow like a quadratic curve, right? So one more node will make it like, that number squared, like the benefit for the entire network. And I think if we get to 10 stablecoins, 20 stablecoins, I think we will begin to see like, oh, this use case can interoperate with that use case, and that's really cool. This is a payments use case. This is a loyalty use case. Payments needs loyalties. Payments needs points. You guys should work together. There's a gaming use case here, like, well, I can withdraw my gaming dollars and like pay for something in the real world. We will see this interoperability in the same way that, today you pay me on Venmo, and then I need to use that dollar on, my Netflix account maybe, but it's very clunky to interoperate with these use cases. You need to be jumping through hoops, while ideally we would have just a network that everybody is increasingly building on top of, and it's going to make the experience better for everyone.
That's amazing. The answer was amazing, because it really showed how M0 is a federated stablecoin.
Yeah,
like the Fed versus the central bank.
We have been called by some folks on Twitter as the future central bank or decentral bank of internet money. I think it's a very ambitious thing. I don't wake up in the morning and think I'm going to build the next generation central bank. Obviously, we live in societies governed by states and regulated by regulators and with policy and all that. So I think it's a bit dystopian to think that, you can build a central bank for internet money. But technically speaking, there's some truth to that. Like from a functional point of view, it's not too dissimilar from that. So I'll take it. Yeah.
Well, Joao, we're running out of time, and so I think final question. What does winning look like in the next year, 3 years for M0?
Yeah, good question. I think we want to continue to grow this flywheel that we have found, as I said, right? It's really hard to grow a two-sided platform. Which side do you grow first, and how do you break that cold start? I think we have broken that cold start. I think we find ourselves in the very, very beginning. So we still want to grow from 5 stablecoins to 10 to 15 to 20. We want to grow from 2 issuers to 3, 4, 5. Probably you don't need a whole lot more than that, at least for the foreseeable, like 12, 18 months. And then I think we will get into the big leagues, as we say. I think we will be, as a collective network, we will be in the top 10, stablecoin projects by TVL. If we get to like $2 billion, let's say, in size, I think we get there. So we have that ambition. And then if you're in the top 10, I think you can enter different conversations, right? Our ambition has always been to to power the next generation of fintech builders, not necessarily crypto native people. We love the crypto native space, and that's where we excel today. And those folks, they are invaluable for us because they bet on us, they believe on us, and they also take risks, right? They are like, this technology is new, but I'm going to try it because that's the way that we think about things. There's a whole lot of different breed of builders, right? People who build fintechs that, take more calculated risks or think differently about the adoption of technology. I think once we get to that size, that top 10 size, and we have like tremendous backers on our cap table, folks like Ribbit and Bain and VCs that have invested heavily in fintechs, and they're very interested in making those introductions to us. We're kind of taking our time, but I think winning for us will eventually be when you have a very successful fintech product, super mainstream, that has a dollar balance and people don't know, but it's powered by M0 in the back end. That's kind of the dream for us.
Can't wait for the day. Thank you so much, Joao.
Thanks for having me.
Yeah, that's a wrap. Yeah.
Thank you.